that episode from Friends where Ross was trying to move the couch and they were trying to go up the stairs? He annoyingly said pivot a million times. Well, I thought this would be a good meme to put in for our video, which we're going to talk about the main catalyst for what happened with the stock market over the last month or so, and that was the Fed doing a pivot. And what are the ramifications to the stock market? What are the assumptions that the market is now making going forward that may or may not come to reality, and how it's going to affect your portfolio? So let's get started. All right, let's get started with the asset class returns. So as you can see here by the blue bars, that's for the month of December. December was a pretty darn good month. In fact, as you can see from small caps and real estate and even in the fixed income space, most of the returns that came from the market came all in this 1 month. Again, that's the danger in trying to time this stuff. You can be out 1 month and you can miss out almost the entire year. And then I'll also highlight large cap. It wasn't up as much as small caps, but still up a big 4.5%. And it was up total for the year 26+%, which brought us back to hitting the highs that we saw 2 years ago. Yes, it's been 2 years since we've seen the high in the S&P 500. So that was great to see. International did well. In fact, developed international actually did a little bit better than the domestic. So that might be a little preview of what's to come here if the Fed continues with this pivot, which we're going to talk a little bit more about in the update. Also, you see commodities was down. That's the one asset class that was down for the month and for the year. Thankfully, we lowered a lot of our exposure to commodities. We actually added to gold, and gold was actually up double digits for this year. So that definitely helped in our exposure there. So let's get more into the update. All right, so what was the catalyst to such a good December? And I would also argue for a good November in anticipation of what was happening here with the Fed meeting in mid-December. So what happened is the Fed paused again, which means that they left the rates from 5.25 to 5.5. They left them the same. But then the guidance changed. So instead of talking about, well, we still might hike again and maybe we'll do some cuts next year, now they talk more about, well, we're actually going to consider maybe doing 3 cuts next year, which was more than they guided before. And of course, the market heard 3 rate cuts, and we're thinking about rate cuts, and they just take it and run. We'll talk a little bit more about that in the outlook. Maybe it's getting a little carried away, maybe not. But it means a lot of things here to me. So first of all, what it means is that the Fed is a little bit more concerned about the economy rather than inflation, or at least it's shifting more to the economy rather than inflation. So that's good and that's bad. That's something that certainly we're going to be looking out for as well. And now, instead of when something that was good ended up being bad for the markets, now when something good happens, like a good report for the economics, or job report or ISM report, when good numbers come out, it's going to be good for the market as well. So now that correlation is back to normal because the Fed is kind of removing themselves a little bit from what's been happening to the market. So all that is good. And when the Fed talked about maybe loosening a little bit, the dollar took a big hit, went down. And so you actually saw the dollar have one of its biggest moves down this month. It was down 3%. It was a pretty massive move. One of the reasons you saw international stocks do as well as they did. So now let's get into what's going on with the market and the outlook for the rest of the year. All right, assumption number 1, the Fed cuts rates 6 times. Now, that seems pretty aggressive. In fact, that is more than they said they were going to do. So the market, which oftentimes is more right than the Fed himself or herself, is pricing in 6 rate cuts. In fact, you could see here that this is the chart that shows by the end of the year what rates are going to be at. And the highest probability is somewhere right around 4%. And remember, we're at 5.25, 5.5. So that means with a quarter point cut each time, that's 6 cuts. Now, to me, that seems a little bit aggressive because you could see that, well, it's not on this chart, but on the other charts, you can see that March actually shows like a 67% chance of a cut, and that's just 3 months away. So inflation would have to come down very dramatically, I think, for the Fed to actually want to cut rates that soon, or we'd have to see a breakdown in the economy. And it doesn't seem like either of that is happening in my estimation. So I think the market might be slightly disappointed that these Fed rate cuts might happen a little later in the year. So there is a little room for disappointment there. All right. Assumption number 2 the market is making is that we're going to have no economic slowdown, basically a soft landing or even no landing, which is a little bit more aggressive than my base case where I thought we would be 50-50 between a recession and a soft landing. Now, how do I know this? Well, as you can see here, this is a chart that shows the price versus the earnings, the PE ratios. And you can see where it is. So historically, we're at a high level of price versus the earnings. Normally, we're right around 16. Right now, we're closer to 19.5. And so the market is priced pretty aggressively for things to kind of go pretty well. And so I think that might be a little tad aggressive, but we'll have to see because the economy has been very resilient. In fact, today we just saw another jobs numbers for the month of December. That was very strong. So maybe that will be the case. So that's something that we'll have to keep a very close eye on. All right, assumption number 3, there's going to be solid earnings growth in the year of 2023. And so part of the story with a soft to no landing with the economy, right? The corporations actually pick up in growth versus last year. So when you look at this chart here, you can see that for 2023, there was virtually 0 earnings growth, okay? And so the forecast, the consensus forecast by analysts is for 11% earnings growth in 2024. Now, that I feel is a little bit aggressive, especially since the average, as you can see here, over the last 20 years or so, is somewhere in the 7% range. So you're going to get better than average earnings growth when the Fed has raised rates a ton and that lag effect that's working its way through the economy. So you can see I'm a little skeptical of this. I'm hopeful that maybe that will happen and maybe rate cuts will help, but and maybe deflation will be so strong that the companies will be able to boost their earnings that way. But again, I'm a little skeptical of that. I think that inflation is gonna go down, but not as fast or fast enough to get this kind of earnings growth for 2024. All right, assumption number 4 that the market is making, no additional geopolitical turmoil. Okay, now you might say like, well, how do you know that the market's not pricing that in, Demel? Well, the best way to look at geopolitical turmoil, I feel, is looking at oil prices. So this is a chart that shows the price of oil over the last 3 years. And you can see how there's been some spikes here recently. And you can imagine what happened here. Right before this big spike, we had Russia invading Ukraine. Okay, that makes sense. And then you can also see another pretty big spike that happened right around the time when Hamas attacked Israel on October 7th here a few months ago. But when you look at what's happened since then, we're actually seeing oil prices go down. In fact, that's what's been helping inflation. One of the reasons you've seen commodities negative year to date, so on and so forth. And so if there was a lot of geopolitical turmoil, well, would oil prices be going down? Possibly, but I would imagine that that shows that there's a lot of stability in oil prices and around the world geopolitically. So that's what the market's pricing in, at least. That may not be the case in the future. So that's something that I'm a little anxious about. There's still a lot going on with the Middle East, especially with Iran right at the moment. So that's something that we'll have to keep a close eye on to see if the market's got this right. The last assumption that I want to bring out about the market is that it's not really pricing in a lot of political chaos. All right. And you know what's happening in 2024, right? We're having a big election. It's a presidential election. And we haven't actually made any long-term compromises with our fiscal spending. So there could be more shutdowns that happen in the year 2024. And so why am I saying that the market's not really pricing in a lot of political chaos? Well, I could see that by looking at the 10-year Treasury. You can see how it went up a lot. This was right around October when we had those big announcements from the Treasury and all the new money that they had to spend and they had to borrow coming off the last shutdown and all the spending that they did for 2023. And you could see that after that, we've actually had rates come down quite a bit. Now, part of the story there is things have been going fairly smooth with the Treasury auctions. And now recently you've had the Fed announce that they're going to start cutting rates next year. So all that was part of what helped. But you have to wonder if there's going to be some more chaos politically, if that's going to make rates go up. And if rates go up, that's going to make the stock market have a little bit more headwinds, okay? And so there could be some more turmoil there with the politics, which will turn into a little bit of a headwind for the markets. Now, I will add that during presidential cycles, this fourth year is usually a pretty good year, especially when there's an incumbent. So you got that facing it as well, which is usually a tailwind. So which one's going to win out? We'll see. All right, so let's talk about the Hartwood implications. So essentially, we're still staying neutral with the portfolio of stocks versus bonds versus cash, okay? And so as hopeful as I am of this soft landing or no landing scenario, I think the market is priced it in almost completely. And now the probabilities for a letdown have gone up quite a bit. So my conviction for a beautiful path going forward with the market has gone down because of that. So that's why we're going to position ourselves a little bit more in the neutral camp. Also, the market's gone up so much. So when it goes up this much this quickly, it's not always the wisest time to be adding risk. And so that's where we're positioned for now. Now, we have been making a few tweaks along the way in stocks. We're adding to real estate. We're adding to high income equity. Those I think will do well with a lower interest rate environment and the stock market that's kind of volatile and kind of moving sideways. With rates already peaking and starting to go down, bonds are going to do very well. This is going to probably be one of the best years for bonds that we've seen in a while. So we want to have quality bonds in our portfolio. And if we go a little longer in the duration, that's also, I think, going to be very helpful as rates go down. So you don't want to have too much cash. Cash is always nice. It's still paying pretty good. But as those rates come down, the yields are going to be less. So you'll definitely want to be shifting from cash to bonds and some of this higher yielding equity, which is what we're going to be up to. Of course, we're constantly monitoring things. If the stock market starts to hit those assumptions better than I thought, I will gradually start adding to the risk. But I do feel like there could be a little setback, a little correction sometime here in the first half of the year as we digest how much the Fed is really going to cut those rates. We shall see. But thanks for watching, guys. I hope this was helpful, and please feel free to share this with your friends. And God bless. Bye-bye.